Hello, and welcome to Arnerich Massena's first quarter 2020 MarketCast. In the past month, we've all adapted to new routines. For example, I'm speaking to you today from my home, and chances are you're watching this from yours. In this time of no engagement, we're reflecting on how deeply we value our relationships, which is why we wanted to start today by thanking all of you, our clients. You are our inspiration to continue to work hard and succeed. You are the reason why we will always be forward-looking instead of through the rear-view mirror like most of the investment industry tends to do. I am proud to be a member of this advisory team, for our portfolios are positioned well to weather these current market conditions. We are forward-looking, opportunistic, long-term, and determined to leave things better than how we found them. We are focused on doing exactly what it is that you hired us to do: help you achieve your goals and objectives, pay attention, and communicate. For it's how we respond during these challenging times that will help us shape our future. First, Bryan Shipley will review the investment challenges and opportunities that we see, and then later, I will outline how our client portfolios are currently positioned and some of the ideas we may be implementing in the coming months.
Thank you, Reegan. Before we dive into the results for the quarter, I want to encourage investors to remember that the performance shown is simply a snapshot in time on March 31st, 2020, in what is truly a dramatically evolving landscape. Given the amount of uncertainty and how quickly we are able to stop the spread of COVID-19, treat those who have been infected, and what the path forward looks like to getting back to what will be our new normal, the market is simply moving on emotion and sentiment as opposed to true known fundamentals. An analogy for the quarter is somewhat akin to providing a final report card while school is still in session and there's so much left to be learned. The chart displayed on the screen illustrates the asset class returns for the first quarter of 2020. Simply put, safe haven assets such as high-grade fixed income held their value. The US dollar was the largest beneficiary of the uncertainty, as the dollar dramatically appreciated due to short-term and over-levered investors seeking liquidity wherever they could find it. Equities across the board had their worst quarter in more than 10 years as stock markets declined across the globe. It has been over a decade since we experienced a bear market, and this next slide puts the recent downturn into perspective. This exhibit covers the performance history of the S&P 500 over the last 50 years. The green shaded areas are bull markets when markets are climbing, while the red denote bear markets when markets are falling. You can see that the average bear market is generally substantially shorter than the average bull market, lasting only about 12 months, while the average bull market has lasted over 4 years. So bear markets are certainly uncomfortable when markets are falling. We can see that they tend to be short and sharp. The COVID-19-led bear market of 2020 certainly stands out given how sudden and severe its onset was. Navigating this bear market is going to require a lot of attentiveness because opportunities can come and go fairly quickly. Stock markets generally get most of the headlines. However, bond markets are a better indicator of the financial health of an economy. In the first quarter, bond markets experienced tremendous volatility, with the rates on the 10-year Treasury hitting a historical low of 0.32% at one point during the quarter. In this chart, the vertical bars show the wide range of returns that each bond sector had during the quarter, while the squares show where each sector closed. At quarter end, defensive high-grade bonds showed gains, while economically sensitive bonds had declined. Investment-grade corporate bonds provided a good illustration of the illiquidity experienced in the markets at one point in time, as they declined more than their riskier high-yield counterparts. As we look into the future, we anticipate that a resumption of economic growth could lift economically sensitive bonds, while lower-yielding high-grade bonds will be more likely to underperform. As always, we'll be looking for attractive entry points into some of the more growth-sensitive parts of the fixed income market. And in the highly dynamic equity space, investors followed a somewhat similar script. They sold off risk-sensitive small cap and value stocks at a very rapid pace, while larger growth stocks fared better. Once again, we foresee a buying opportunity in small cap stocks and managers focused on resilient businesses that, as markets normalize, should experience a strong rebound. Let's further validate this small cap opportunity by looking at it in the context of a historical economic cycle. In this chart, we can see that since 1926, small cap stocks have outperformed large cap stocks by 1.9% annualized. And this makes sense because over the longer term, markets generally reward risk-taking. And yet, as of quarter end, we've been seeing large cap stocks outperforming small cap stocks by their widest margin since 2000. This recent outperformance of large cap is not too surprising, since historically, large companies typically protect capital better during the onset of a market downturn compared to small companies. However, coming out of a recession, small companies have historically outperformed large companies by 3.3% annualized over the next 5 years. Additionally, large cap stocks have been a beneficiary of cheap access to capital, of which a significant portion has been used to buy back shares, further inflating their stock prices, a trend that we do not anticipate will persist at least at the same magnitude. So, knowing where we're at in the market cycle, we think that we could be setting up for a period of significant small cap outperformance. But regardless of market cap or style, we believe the companies that are best positioned to survive periods of economic stress are high quality companies, those with low levels of debt relative to their earnings, and business models that are resilient and capable of weathering unforeseen economic shocks. For example, companies that entered the global financial crisis with a low debt-to-earnings ratio returned 3.4% more annualized over the next 5 years compared to more indebted companies. The exhibit on the screen details the debt-to-earnings ratio of traditional benchmarks in comparison to the average Arnerich Massena approved manager portfolio. You can see that small caps in particular tend to carry dramatically more debt than large cap stocks, which is a large reason small caps sold off so dramatically during the quarter. We believe this is an environment that favors an active approach to investing in the stock market and working with managers who have perspective on the markets and are able to sift through some of the indiscriminate selling that has occurred to uncover tremendous forward-looking investment opportunities. During times like these, we take comfort in knowing that our investment managers are well positioned with a very low average to debt earnings ratio and much higher quality than the highly indebted indices. And now, to put all these ideas together in terms of portfolio positioning, I'll hand it back to Reegan.
Thank you, Bryan. As he pointed out, we're currently in a very dynamic period that will require attentiveness and quick action. We are currently looking at 3 potential buying opportunities within traditional investments: small cap stocks, higher yielding bonds, and non-dollar investments. These areas have experienced indiscriminate selling, and we have managers ready to take advantage of these opportunities. But as we wait and watch for an entry point, our current positioning remains in effect. This includes defensive, low duration, higher credit quality, looking for attractive opportunities in small and mid-cap stocks, a modest overweight to international, especially emerging markets, and where appropriate, we've been tactically harvesting tax losses. But once again, as Bryan mentioned, the timetable for making any tactical changes will need to be flexible during this dynamic market environment. Your advisor will work closely with you to keep you informed about specific investment opportunities as they become available. Please look out for our upcoming webinar, Forward-Looking Investment Opportunities in the Wake of a Pandemic, coming soon. In this webinar, the first of a spring series of webinars, we'll be talking about specific opportunities we see coming out of the current market environment. Thank you for joining us today.